But before we even start talking about where the money comes from, you need to take a good hard look at your own financial situation, right?
Absolutely. A self-assessment is crucial before you even consider financing.
Like a financial checkup.
Exactly.
Yeah.
It helps you figure out which funding options are realistic for you, and it prepares you for the scrutiny you'll face from lenders.
So where do you even begin with this personal financial deep dive?
Your personal credit score and history are a great place to start.
Credit that three-digit number that follows you everywhere.
It does, and it carries a lot of weight.
Yeah.
Lenders use it to assess your financial responsibility.
So it's not just about getting a loan, it affects the terms you'll get.
Absolutely. A good credit score can mean lower interest rates and a smoother approval process.
So what's the typical range for credit scores and what's considered good?
Credit scores typically range from 300 to 850. Most lenders consider anything above 700 to be good.
Yes, 100. Okay.
That shows a solid credit history and responsible borrowing behavior. And 750 or higher, that's often considered excellent.
Excellent credit.
That can open doors to the most favorable loan terms.
So it's not just the score itself, but the story behind it, right? Your credit history.
Yeah, absolutely. Lenders want to see how you've managed credit in the past.
Do you pay your bills on time? Do you use a lot of your available credit?
Exactly. A consistent history of on-time payments, keeping your credit utilization low, meaning you're not maxing out your cards and having a mix of different credit types, that all looks good to lenders.
So it's about showing you can handle credit responsibly.
Exactly.
So if someone is thinking about franchising, what should they do first, credit-wise?
Get a copy of your credit report.
From all three bureaus.
Yes. Equifax, Experian, and TransUnion. You want the full picture.
And you want to check for any errors or inaccuracies that might be dragging your score down?
Absolutely. Dispute those errors if you find them. It's worth the effort.
So what if your score isn't quite where you want it to be? Are there things you can do to improve it?
Absolutely. There are definitely things you can do.
Like
The most important thing is to pay all your bills on time every single time.
That's the foundation.
It is. Then work on reducing your credit card balances and overall debt.
So showing you're managing your existing debt well.
Right. And try to avoid applying for new credit unless you really need it.
Because too many inquiries can ding your score.
They can. And keep your older credit accounts open, even if you're not using them.
So the length of your credit history that matters.
It does. And aim for a healthy mix of credit types used responsibly.
Credit cards, loans, maybe a mortgage if you have one.
Right. Remember improving your credit score. It takes time. But even small improvements can make a big difference.
It can open up more financing options and get you better terms.
Exactly.
Okay, so credit score checked. What's next in this personal financial assessment?
Next, you need to get a clear picture of your assets and liabilities.
Assets and liabilities.
Okay. It's like creating a personal balance sheet.
So assets, that's everything you own that has value.
Right. Think cash in your bank accounts, investments, real estate vehicles, anything of value.
And liabilities, those are your debts.
Exactly. Mortgages, car loans, credit card balances, student loans, any outstanding obligations.
So once you've got all that information listed out, how does that help you in the context of franchise financing?
First, it helps you determine how much you can realistically invest.
Right, how much of your own money you can put in.
Exactly. And lenders, they use this information to assess your overall financial stability.
So you want to see if you can handle the debt.
Right. A strong asset to liability ratio that can make a big difference in getting approved for financing.
So basically, the more assets you have compared to your debts, the better.
It definitely helps show that you're financially stable and capable of managing debt.
But what if your debts are significantly higher than your assets?
Then you might want to focus on improving your overall financial picture before jumping into franchising.
Getting your financial house in order.
Right. Paying down debt, building up savings.
So you're in a stronger position.
Exactly.
Okay, that makes sense. So we've covered credit assets and liabilities now. Let's talk about the actual cash you have on hand savings and liquid capital.
Okay, let's dive into that.
How important are those in the franchise world?
Savings and liquid capital are extremely important.
And what's the difference between the two?
Savings, that's money you've set aside specifically with a purpose in mind.
Like an emergency fund or a down payment fund?
Exactly. Liquid capital is a broader term. It's any asset that can be quickly converted to cash.
So savings would fall under that category?
It would. And so would things like money market accounts, certain CDs, stocks that can be easily sold.
Okay, so it's how much cash you have access to readily.
That's right.
And why do franchisors and lenders care so much about this?
They see it as a measure of your financial stability.
Like, can you withstand a financial bump in the road?
Exactly. Can you cover those initial costs and keep the business running in those early months?
when you might not be profitable yet.
Right. And many franchisors, they actually have minimum liquid capital requirements.
So you have to have a certain amount of cash on hand to even qualify.
It's to protect them. And
You want to make sure you're not going to be in financial trouble right away.
right. Now, having solid savings, that's obviously a good thing, but it doesn't mean you have to finance the entire franchise yourself.
You don't have to drain your bank account.
No. Sometimes strategically leveraging your savings and financing the rest can be a smarter move.
So you're not putting all your eggs in one basket.
Exactly.
So when someone is looking at their savings and liquid capital, what are the key things they should be thinking about?
Well, first, calculate your total liquid assets.
Everything you can quickly turn into cash.
Right. Then decide how much of that you're willing to invest in the franchise.
How much risk are you comfortable with?
Right, and consider what else you could do with that money. What are the opportunity costs?
If you invest it in the franchise, you're not investing it elsewhere.
Exactly. And think about how this investment will affect your overall financial security.
If things go wrong, can you still cover your personal expenses?
Right. And finally, compare the potential return on investment from the franchise to what you might get from keeping that money in savings or other investments.
So weighing your options carefully.
Yes, making informed decisions.